Hi guys, it's the Bears. They're back. Sell everything in your portfolio. Go to zero. All your stocks must go. It's a President's Day sale, okay? Sell them on the cheap because everything's coming undone, all right? Now, let me show you something a little bit more shocking here that's happening here today in Las Vegas, okay? And we're looking at 74, 95-mile winds for a Category 1 hurricane. And in Las Vegas, we got a high wind warning of 70 miles per hour winds expected here in the next coming hours. So wish me luck. Hopefully we'll survive this. We ain't Florida or Georgia or any of those kind of Gulf states that kind of deals with this stuff normally. So for us, it's very rare. So hopefully we'll make it through. I know I put some 2x4s on my trees out there so they wouldn't break over from the wind because they're probably not used to that kind of wind here. Okay, now it's February 21st. And the Bears are out there, just like we talked about, okay? So we're going to do this market alert and go over the sea of red that's out there because it was ugly out there, guys. Ugly. Those bond yields hitting us hard. We're going to talk about all that, but before we do, please hit that like button, hit subscribe. Hopefully you learned something from these videos and we have some fun in the meantime. Let's get to it. So here we go. So we'll start here with the numbers as usual. We got the Dow Jones down 2% on the day. Ugh, just awful. 2% on the day for Dow Jones, 2% also for the S&P. S&P is the outperformer of the day, down 2%. Forward PE still in that 21 range, 2021 range. Not good, pricey for the S&P 500. And then NASDAQ down 2.5%, and Russell 2K taking the cake at down 3% on the day. And that's why our stocks today underperformed in a portfolio, down 3.5%. For today's change, down 3,565. Ouch. For portfolio, ouch. But we're still performing okay on the year at 26.25%, up 20,453. So far, so good. Okay, now, again, NASDAQ, Russell, down on the day. A lot to do with the Russell today because all these kind of sort of, unprofitable, lower end, very small cap stocks ran up too high, and the market is just selling them left and right today. So we get disproportionately hit on that end. And the VIX going over 20. Remember, it's been as low as 17, 18 in the last couple of weeks. Not a good spot to start setting positions. This gets a little bit closer to start setting positions. If you're looking at stocks that you want to buy, gets a little bit closer. We're looking at the VIX somewhere around 28 to start buying stocks again. Okay, we need a little bit more volatility in the markets to make us feel comfortable, to make us feel like the markets are oversold, because right now I still feel a little bit overbought on the overbought side, maybe a little bit to moderate to overbought. So again, waiting for that VIX at 28 to start showing us the door to add to some positions there. Okay, in the meantime, we just chill and wait. Okay, now bond rates, this is where we hit the problem. Okay, we got a problem with bond rates, guys. There's no other way to put it. We have the 2-year bond yield at almost 5%, 4.68, and the 10-year almost kissing that 4 level. Bad. We'll talk about that in a second here. I'm extremely worried about bond rates because now stocks have severe competition as far as an asset class. Remember, stocks themselves are one asset class of many to invest in, and they get less enticing as bond yields go higher. So we don't want to see bond yields go higher. That's what causes this to plummet like it did today. Okay, we also have energy, 76.10 on WTI, 79.10 last time we talked, still taking a dive. This is what's allowing us to step in, along with Nat Gas, into Devon Energy in our newest position. Devon Energy, Brent, that's the European crude, or the measure of European oil at 82. Last time we talked was 85. That's still dropping. And natural gas still on a fast decline. I mean, this is unbelievable. If we pull up here a chart real quick of natural gas, you'll see here what devastation looks like. And here it is, guys. Look at that 1-year chart of natural gas. It's just completely demolished. And let's pull up here a 5-year, how it comps in the 5-year. I mean, you see this big spike here. COVID moving the price of nat gas higher. Or not really COVID. We're talking about the Russian war, right? And the cutoff of supplies from Russia into Europe. And all of a sudden, the winter in Europe isn't as bad as was expected. And then the price just goes straight down, okay? So that's natural gas. Moving on to the strength of the dollar at 104.17 versus 1 0363 as of last week when we did our last alert. If this gets higher, guys, we also have a problem here as far as the strength of the dollar. Again, repatriating profits for companies gets a lot harder as this goes higher. So not good there either. So very worried about these here. I think 105, I've said it before, 105 is the level in which we need to start getting even more worried about the strength of the dollar and the return to the October lows for all these indices here. Okay, now we're focusing on retailers for earnings, of course, the bond market and how now bonds are working, how they're supposed to, how they've historically worked as an inverse to the stock market. Now, the bond market is no longer calling the Fed's bluff. They're no longer toying with the Fed. They're saying, we believe you. Higher for longer is the norm. Inflation can stick around and be sticky. So we're going to set us higher as far as bond rates go. We're also talking a little bit of Walmart and Home Depot and the economy according to those two. And also to give us an indication where the economy, the U.S., and the stock market is going. We went over the Fidelity portfolio, underperforming today against the market. We have movers, our top movers today, PayPal, Devon Energy. Of course, that makes sense. When you have bond rates go higher, Devon Energy paying almost a 7% dividend yield is quite enticing against other stocks out there. So you're going to see money flowing out of some stocks into these dividend payers, and then Planet 13 up 0.13%, just slightly higher. Bottom movers, Palantir getting demolished today. Okay, a big move for Palantir's moved like what, 50% or almost 50% over the last 30 days, something like that, or maybe a little bit more. Phenomenal move to the upside, but that's got to give. That can't keep going forever, so we get dinged on Palantir. Don't care, no big deal. Corsair down almost 5%, and NXPI, that's NXP Semiconductors, down 3.75%. Don't care about these two going down this much. Now, bonds was the focus today as far as all the news, everything that's been going on, and it makes a lot of sense. If we pull up a note here or a list of Treasury yields from the 1 month to the 30-year, you'll see here, put a little cutoff line of the 6 month because I think that's pretty important. You see a 6 month yield at 5.14%. Man, that is high on a 6 month yield. Unbelievable. We also have the 2-year 4.68 and the 10-year 3.95 ending on the day. I mean, horrible numbers as far as bond yields. If you're stock market enthusiast, a stock market investor, horrible news here. Okay, and I mean the train of thought is very simple when it comes to the risk proposition because it's all about risk mitigation when it comes to bonds, right? Why would you go, or why would one go and say, hey, I want to buy Starbucks stock because of this new drink called the Oleato, which is a revolutionary new coffee that puts extra virgin olive oil into your coffee to make it velvety smooth and delicious lush. A new coffee experience, right? And I'm so bullish on Starbucks because of this new coffee that they're going to come out with. And when you see that Starbucks is trading at a ridiculous, expensive valuation of 31 times forward earnings and 37 times current earnings, why would you buy Starbucks at this valuation when you can make 5% or north of 5% on a 6 month bond yield, a Treasury note? It makes no sense, right? So people and the markets are always going to make the choice of safety, a safe, zero risk 5.1% dividend yield or annual dividend yield versus a Oleato coffee experience trading at 37 times current earnings. That's essentially the explanation there as to why bonds are just much more enticing now than stocks. Now, moving on here, we talked about in our last video on how the earnings focus for the week is on Walmart and Home Depot. And we see here Walmart with pretty solid numbers to beat expectations on earnings per share and revenues. Pretty healthy beats there, but they're still guiding below expectations. Remember, we talked about it's about the guide, guys. Guidance is what's going to set up a stock moving forward. We did see some positive moves from Walmart on the stock today. Let's check that out before we highlight it here. And we do see a pretty muted move today for Walmart. Green nonetheless on the day, and aftermarket slightly green. but at the same time, it's green on a really, really red day when Walmart is a major part of the S&P, major part of the Dow. Is it of the Dow? I'm not sure. I'm having a brain fart here, but I'm not sure if it's part of the Dow. Let's check. And here we go. Here we got the Dow 30 chart and Walmart down here, down towards the bottom. So, okay, yeah, Dow Jones moving lower, especially moving lower by that much, by close to 2% on the day, and Walmart going green is quite a feat. Now, in regards to the highlights for Walmart, we got 7.3% higher on the year-over-year number, the sales number for year-over-year. That's pretty strong for Walmart. E-commerce growth doing great, 17%. They're saying they're taking market share in grocery. That's probably their delivery, sort of pick-up delivery service. I know they have that Canoe. If you guys seen that Canoe vehicle, pretty cool delivery service for Walmart. They're trying to sort of take some market share from Amazon there. And then Sam's Club comp sales up 12.2% and 22.6% on a 2-year stack. That's great, very good. Membership income higher by 7.1% with member count at all-time high. Of course, when people fear recession, you're going to get those numbers at all-time highs, sort of like a Costco, competitor, which is what Sam Club is. Okay, now the Q1 guide, it was up for net sales up 4 to 4.5% on a constant currency basis. Again, not taking into consideration the fluctuations of the dollar, which can affect the revenues, or not the revenues, the profits of companies doing business overseas, with an EPS 125 to 130 when the expectation was 137. Tame guidance, guys. And then on the full year guidance, net sales up 2.5 to 3 on constant currency. US 2 to 2.5. Sam's 5%. That's pretty nice there on Sam's, excluding fuel, and international up 6% on a constant currency basis. So international stronger than the US. There's a lot of ground to make up there in Mexico, Canada, China. If you remember, we as far as the U.S., we're more advanced at taking care of the pandemic, COVID era, issues. China's barely getting out of this, so that's probably where you're getting a higher guide there, and a miss on the annual EPS, 605 on the high end versus 651 expected. That's a big miss on the full year 2024 guidance. So that's why we have a pretty substantial below expectation guide down there. Okay, and then dividend hike 1.8% to 57 cents from the prior 56. That's good. Dividend hikes are good. And then gaining share across income cohorts, including the higher end. That's key, guys, which makes up nearly half of the gains we saw in the U.S. again this quarter. So here's Walmart telling you, we're taking share from other retailers. Who is that? Costco and Target, in my opinion. They're taking share from those guys because Costco gets pricier and pricier. And so does Target as far as the cost of everything as their inventories get recycled over time. So I think Walmart is doing the best job as far as inventory levels there and keeping everything as inexpensive as it can be, especially grocery, as opposed to groceries that are much more expensive at Target. Maybe not Costco, but at the same time, I think Costco, with the amount of members they have and how full those stores are all the time, I can see how Sam's Club becomes more appealing to some buyers. Okay, so pretty good there. Probably like a B minus, or solid B as far as earnings for Walmart, given their guide below expectations. If that was better, it definitely would have been an A plus. And then we have the other story of the day, which is Home Depot, okay, which beat on profitability, the earnings per share, but bad miss on revenues, and the guidance is just horrible guidance. Okay, so only Q4 sales up 0.3% year over year, or 112 million more than the year before, the same time the year before, and the comp sales growth down 0.3%. Terrible numbers there as far as the growth in Home Depot, and I can see this happening because there's a lot of pull forward. We've talked about pull forward before during the pandemic, during the lockdowns. Everybody and their mom went to Home Depot and started buying things to improve their homes. Now that their homes are improved, what is there left to do to improve your home? If you did your kitchen, your bathrooms, your backyard, and you made it into this great livable place, so if you were locked down for 5 years, you could have fun and enjoy your time at home. That's already done. So I can see a lot of pull forward there from back in those days, and now that demand is no longer there for maybe at least the next year, maybe longer. And sales up 4.1% versus 2021. Net earnings 17.1 billion versus 16.4, so marginally higher on the net earnings. And in 2023, beginning 2023, they're going to invest $1 billion in compensation for frontline hourly associates. Very surprising to hear this, or maybe not surprising, but maybe for Wall Street, something they don't like to see. So remember what we talked about before when we heard about Facebook, when we heard about Dell, when we heard about Amazon laying off employees. Wall Street loves layoffs. And what is the opposite of layoffs? This right here, what Home Depot is giving you. Instead of laying off folks, we're going to pay them more. And I think this is because Home Depot doesn't have the luxury in a tight labor market when fast food chains, Chipotle, when Chick-fil-A pays their hourly employees so well. Home Depot has to keep up with that. And this is them keeping up with that inflation, sort of wage inflation rate, so they don't lose their best employees. So something I think they have to do in order to keep those employees around, because otherwise they're going to scram and they're going to go do something easier that is not as complicated as working at Home Depot, because I believe working at Home Depot is pretty complicated, a lot to learn if you don't know your way around the house and you're not very handy. Now, 10% increase on top of that of the dividend to $2.09 per share, or $8.36 on an annualized basis. That's another expenditure there that I don't know that it's that necessary in this environment. And then flat guidance on sales growth and comp sales. Totally flat. They're saying we are not growing this year at all, and lower operating margins, lower than expected. The expectation was 15.5. Margins came in at 14.5. That's another miss on operating margin. Now, what's keeping Home Depot afloat at the moment is the average ticket price of a basket or a shopping cart for a customer. Looking at $90 today versus $85 the same a year ago. Because you see here on the customer transactions, they are down over the same time last year. Today they're reporting 378.5 versus 402 the same year below as far as the customer transactions in millions of transactions, and the average ticket price is higher with lower customer transactions. So this is what's keeping them afloat at the moment and keeping their stock from complete collapse, because their stock ain't cheap, guys. The stock's still trading at a pretty good valuation. If we look here, we go back to Walmart, but we type in Home Depot, you're going to see here forward P maybe in the high teens. Let's see here, 19.1 forward PE and a current P of 19.36. We see here price to sales 2, price to book 252, expensive, and PEG, price to earnings growth ratio 2.78, expensive as well. And that makes a lot of sense. Paying 19 times earnings on a company that's not growing sales, that's asking a lot, guys. This should be trading at 12, 13 times forward earnings if it's not growing sales. So expensive at the end of the day. This is a stock that right now I wouldn't pay over $200 for. So a lot to go there as far as share price depreciation, in my opinion. And I would not get into the stock at any point unless it was under 200 a share. Okay. So that's what we're learning. That's what we're learning for the economy from Home Depot and Walmart. Essentially, imagine if they miss these sales guides, guys. If it's not flat, if their growth isn't flat year over year and it's less, I mean, that's a complete disaster for Home Depot. And I'm thinking again, pull forward on demand is a mother effer, right? When we talk about that, it's a killer. Tech companies have seen it. Like Sherwin-Williams has seen that. That's the paint company. All that pull forward just kills you in the next couple of years. Those are companies that were over-earning and over-hiring and just explosive growth that couldn't be maintained forever. That growth is just no longer there, and they're struggling to keep up with it. Okay, now I hope that gives you guys some good stuff to kind of think about with Walmart and Home Depot and how they're seeing the economy, or how you see the economy through their eyes. If you guys have any questions, please let me know. Subscribe to our channel, follow us on Twitter, Instagram. Please let me know how I can help you in your investing journey. Peace out.